This is our next lesson on tax. So what we're looking at here, we're just going to be finishing the theory in the chapter, and obviously we spend most of the time here looking at what obviously tax is levy imposed by the government on individuals and businesses, something people have to pay. And we focused on tax with households and businesses. We'll be looking at that again soon, and mainly focused down here on PAYE. PAYE modernization, and regarding, nowadays that there's a system set up so that you start your work, you obviously are paying your tax, and you can check this online, and then when you cease employment in that organization, the revenue commissioners and the online revenue system will track when you finished and obviously when you start your next job. But how is all this calculated? So we'll be looking at that soon in terms of how we calculate our PAYE. But first, we're looking at tax non-compliance. So there's two things here: tax evasion and tax avoidance. One of them is legal and one of them is illegal. So evading tax is illegal and avoiding tax is perfectly fine. So what's the difference? So avoiding tax, we can avoid tax by generally taking up on certain initiatives, certain schemes. So for example, I'm a public sector worker, I'm a teacher, and 5% of my gross wage automatically goes towards a pension. I don't have a say in the matter. But there are a lot of other people that would be working in a business, and they would also take approximately 5% of their wage every week and put it towards a pension. That money is not taxed. Any money you set aside for your pension is not taxed. From your straight out of your paycheck to your pension is not taxed. And the reason it's not taxed is because obviously you want to encourage people to have a pension. If nobody has a pension, then people do not have a steady source of income when they're in their 70s or 80s and 90s, and that's obviously messy because now you have people in their 80s who still have to find work, or they're living in a very, very underfunded manner, I would say, in terms of not having enough money to have a general living. So we have these initiatives set up for people in order for them to obviously to pay into their pension. They can avoid paying tax on that money. Other things where you can avoid paying tax, a lot of environmental policies, more and more of them will start coming out, where there will be an encouragement for you when you're building your house to put in certain like green initiatives, in order, nowadays you can't have a chimney in a house, you have to have an air to water system, things like this. But previously these kind of things would be encouraged for people to kind of take up on these healthier environment, I suppose, schemes. And if you did do that and you did buy these systems, then you could probably get tax back on certain things or avoid paying tax on certain things. So this is perfectly legal, and they're generally initiatives set up to encourage people to take a certain action, like paying to a pension, or like going with certain environmentally friendly services, maybe, rather than a traditional one that would be damaging to the environment. So that's tax avoidance. Tax evasion is just simply not paying your tax. Tax evasion, generally in most cases, is people not declaring income to the government and trying to avoid paying tax on it. And it's extremely common. A lot of people work cash in hand jobs. You go and you work somewhere, you get paid in cash, and the government have no idea that you're getting paid this money, and obviously you're not paying any tax on it. Other things as well. I mean, in a couple of years' time, most of you, maybe some of you might, be moving in with friends into a house, going to college or something like that. You'll probably be paying rent to some landlord, and you'll be paying rent in cash, because in a lot of cases you'll find that there's people who might own property and might rent it out, and they are not declaring all of their income. They're not declaring all of their income because they're not going to get taxed on it if the government don't know they have it. So if a simple example, if I run a barber's, and every customer comes in pays me €10, so I get 100 customers, let's say every month. At €10, that's €1,000, or every week, let's say. At €10 a customer, that's €1,000 a week. 52 weeks of the year, that's 52 grand. So I get 52,000 euro. If I tell the government that I've earned 52,000 euro this year, I'll pay a certain amount of tax, maybe let's say 17 or 18,000. But if I pretend that I only earn 30,000 this year, I might only pay 13,000 or 12,000 tax. Therefore, I can save out on a good bit of money if I don't declare all of my income, and that's tax evasion, and it's illegal. So it's generally in the form of not declaring all of your money. Tax evasion is illegal. There's a lot of different sentences, ranging all the way up to a prison sentence, and the revenue commissioners would basically kind of work very, very hard in order to track people down who might be evading tax. Now, for calculating tax, employers are responsible for calculating and collecting tax paid by employees. Employees need to understand how to calculate their own tax just simply so that you can check to see that you're paying the correct amount of tax. So it's the employer's responsibility to calculate tax, and generally it's collected straight out of an employee's paycheck. But how is it calculated? It's not just a simple thing of saying this is the money you earn, multiply it by this percent, and this is your tax. There's more involved. So this is our way of calculating tax, and I've given just a little story down here. We won't need to look at this for a second. Let's just say there's somebody, John, they earn 30,000 euro a year, and they get overtime here of 5,000 euro. So their pay is 30,000, they've overtime of 5,000, obviously for working additional hours, and let's say Christmas they get a bonus of 2 grand. So if you add up the basic pay, which is John's 30,000, he works for 15 euro an hour, he works so many hours and he gets paid 30 grand. His overtime for working additional hours, and his bonuses, maybe his Christmas bonus. If you add up those three figures, you will get John's gross pay. So that's just his gross pay. But the next level of that is gross income. So gross income is your gross pay, which we just calculated, plus financial value of benefit in kind. So let's say John's a delivery driver for An Post. In most cases like this, if you're doing a service like this, they'll give you a van. You'll have a van, you'll have a car, something like that, that you can drive around in for the deliveries. And that can be given to you as a financial benefit in kind. So they're giving you maybe, and certain employment, they'll give you a free car. Other people might just get a free phone, but they might get free credit if they're involved in making a lot of business calls. So these are financial benefit in kinds. Benefit in kinds these are benefit in kinds given to you, and obviously we're just estimating the financial value. So let's say we estimate the value of the van to be 13,000 euro. So he gets this van for 13,000, and he also had a total gross pay this year of 37,000. If we add up his gross pay, which we got above here, and we add up his value of his van, we now have his gross income. So that's his gross income. So now when we're looking at calculating his tax, we'll multiply his gross income by the appropriate tax rate. So his gross income is 50,000. Some of that will be taxed at the lower rate, some of that will be taxed at the higher rate. So we'll multiply it by the appropriate tax rates, and then we'll have his gross PAYE tax. And quite simply then the final step is that if you have your gross PAYE tax, let's just say his tax works out here at I don't know, let's just say 12,000 is his tax, so that's his tax for the year. He might have tax credits of 2,000. So his tax, his gross PAYE tax is 12 grand, his tax credits are 2,000. What we're saying here is that, okay, he's earning, or he's basically having to pay 12,000 in tax, but a tax credit is money you can receive back from tax. So tax credit is basically tax that you do not have to pay. You get credit towards paying, you don't have to pay this. So if his gross PAYE tax is 12 grand and his tax credit of 2,000, his net PAYE tax is going to be 12,000 minus 2,000. So his net PAYE tax, the tax that John will have to pay at the end of the year, will be 10,000. So there's a lot more involved than just just multiplying your general income figure that you think you've earned by a certain percentage. We looked at his basic pay, how much you'd earn, your normal working contract, along with any overtime, along with bonuses. This is gross pay. We then added that to any benefit in kind, maybe free phones or free vans or anything like that. All the value of that added up to his gross pay, and we have his gross income. We then multiply that by the tax rates, and that's our gross PAYE tax. And then you just take away the tax credits. And that's where we work our way all the way down to the net PAYE tax. There's not too much left to go in this chapter. So what we're looking at here is just kind of tax implications. So it's the implication of tax for households and business. So what effect does tax have on households and businesses? Well, some positive implications for households would be redistribution of wealth. We looked at before, if there's anyone who's working in the public sector, such as, guards, nurses, teachers, anything along that, we can see here ambulance, fire brigade, or something, maybe potentially some other emergency services. This sector is all paid for by the government, and in order to get the money to pay these people, we need to tax people and obviously have certain amount of money stored away to pay. So redistribution of wealth can also come in term the lines of social benefits, such as paying people who are on job seekers allowance or the pandemic unemployment payment or anything like that. So redistributing the wealth in society and improving public services, roads, hospitals, any school or anything like that. So these are our different kind of things that we can do to develop our public services, and obviously redistributing wealth by paying people maybe a certain wage or social benefits, and these are positives for households. For businesses, well, there's not a whole lot of positives, but we can see here that in Ireland there is a lower rate of corporation tax. It's 12.5%, so it's not that high. And tax incentives as well. Certain businesses there might be a tax incentive so that if they take up in a certain scheme, they can reduce their tax that they have to pay. I wouldn't say overly too positive from a business, but it is for society. Negative implications. So obviously if you're paying tax, it reduces your disposable income. You're losing some of your income. Generally, because most of every good is taxed, you have to pay a higher price. So you walk into a shop, you pick up something off the counter, you're not just paying for the the shop or the supplier, you're also paying tax when you're buying that item. And regressive tax. So I'm just going to get you to write this down into your notes. There's progressive and regressive tax. So progressive tax, just to write it out here. Progressive tax, what progressive tax is that the more you earn, the more you pay. And if PAYE is an example. So taking that down into your notes, for progressive tax, the more you earn, the more you pay. Something like PAYE. If I have a bigger paycheck, I'll end up paying more PAYE tax. Pay as you earn. Regressive tax is different. Regressive tax is everybody pays the same tax, regardless of how much you earn. So regressive tax would mostly be seen as some way a bit of a negative, because obviously you have the super rich, or you have somebody who's just kind of scraping by, and they have to pay the same level of tax on something. An example of a regressive tax would be VAT. If I want to buy a new table and chairs, there might be €80 VAT on those table and chairs. It doesn't matter how much money I have to pay the €80 VAT. It's a regressive tax. If I go into the shop and pick up a carton of milk, there might be 30-cent tax on that milk. It doesn't matter how much money I have. Everybody pays the same tax for items such as that. So VAT is an example of a regressive tax. Negative implications for a business. Over time, employers PRSI, basically money business would have to pay, and discourages enterprise. Maybe it might discourage people from starting a business or from renting a property or anything like that if they figure that to pay a lot of tax. Quite quickly, the last two slides. So similarities for households and business tax. Registration, everybody has to register to pay tax, whether you're an individual or for business. In your employment or you're running your business, you have to pay tax. Tax compliance, you have to pay the correct amount of tax. Tax avoidance, so you can use legal methods to reduce your tax liabilities. There are strategies out there, and as I said, simple things like paying into a pension can reduce the amount of tax you have to pay. And record keeping is advisable. Keep track of the money that you earn, keep track of the money that you're paying, and obviously the tax that you're paying too. Differences between households and businesses. Well, businesses can reduce their tax liability in much more ways. Tax liability is money that you owe. So a business can generally kind of take up in certain schemes, and there's a lot more ways of reducing your tax bill. Whereas for normal employees, it's not as there's not as much kind of, I suppose, ways of reclaiming that money back. Also, for reclaiming VAT, a registered VAT business can claim back VAT paid on its purchases of goods and services. So, if you're a business and you're buying from a supplier and you're keeping track of all the money you've paid for all of your goods, and generally at the end of the year, you can receive a certain amount of VAT back that you won't have to pay. That doesn't work for employees. You can't get VAT back. You can't go into a shop and try to pay for items and then try to receive the VAT charge back. Greater ranges of taxes. There's more taxes applied to business. You have things like corporation tax, 12.5%, or commercial rates charging you on, improving the public area around your building or something like that. And tax collection. So businesses act as collectors of tax on behalf of the revenue. A business will generally charge its own employees the correct tax amount and give it to the revenue commissioners, and obviously households are not involved in that step. This is just the end of our work here for our tax. That's just the end of our theory. We'll get to more on it in our next lesson.